Hello, this is Thomas Wood with AlgoTradersEdge, and today we're going to be taking a look at the micro S&P long only system. Before we get started, just keep in mind that this presentation does not constitute an offer or solicitation of an offer for the purchase or sale of any securities. There is always a risk in trading. There's a risk involved with any type of trading, including futures. So with that being said, let me tell you a little bit more about what the LOD model is and how this works. One of the advantages of trading with an LOD, which stands for letter of direction, is you have the ability to have daily liquidity. So you can get in and out anytime you want. You can close down your account or open your account anytime you have daily liquidity. You pay a monthly, quarterly, or annual fee to have systems executed on your account. So basically you are leasing the system and having the broker execute the strategies automatically on your account. It allows you to get diversification to automated trading strategies in the futures markets. So you can diversify your overall portfolio. You could take a piece of your portfolio, put it in the LOD, and allow that piece of your portfolio to be managed by algorithms in the futures space without having to trade them yourselves or manage them yourselves. It also, because it's fully systematic, it allows us to remove what we call ego, which stands for emotions, greed, and opinion. It's fully systematic and automatic rules-based trading. So you cannot allow your emotions or anything to come in and mess up the trading strategy. All right, now let me tell you a little bit more about the investment strategy for the ATE MES Long Only system. It's a quantitative, systematic, algo-driven technology. So it's a system that's designed to only take long trades in the micro S&P futures. It's designed to achieve alpha by building leveraged positions in strong bull market environments while simultaneously staying flat during bear markets. So we're not looking to go long and short. We're not looking to make any money during a bear market necessarily. What we're trying to do is outperform the S&P 500 as a whole through the use of strategic leverage and knowing when to build up larger positions and when to use smaller positions or stay flat in the market. For example, we've stayed flat through most of the down move in 2020. Now, with that being said, here's a graph showing you the performance of the ATE portfolio versus the S&P 500. Now, this is not net profit or gross profit performance, but it's showing you the equity curve and the volatility. So you can see there's long periods where the market stays flat, the blue line, where the system will stay flat, where, for example, in 2008, the stock market collapsed. Same thing here when the stock market dropped in 2019, and then again, it stayed flat while the markets dropped in 2020. So it keeps us out of the market as the markets go into bear markets, and then looks to jump back in as we come out of those bear markets and start climbing once again to ride out these long-term uptrends, and once again with the goal of achieving a higher annual return with lower volatility from the S&P 500. Now that brings me into risk management and how do we handle the risk with this type of system. So there's portfolio risk management. Every single trade that we take has a maximum stop loss order in place. All right, we start with smaller positions, but then we have the ability to build into larger trades. All right, so we start off small with one contract in the micro S&P futures, and then we can build all the way up to a total of 3 contracts over time. This is an example of what that looks like. This is a chart showing the MES and showing the trades being taken. You can see each one of these blue dots is where it builds or buys a contract. And then the line it connects to is where it exits. And you can see we're trying to ride out these much larger moves. And this is on a weekly price chart here. So let me talk a little bit about the performance of the ATE MES Long Only system. Now this is for a $5,000 investment. And the total profit over the past 15 years is about $28,410. We have an average annual return of about 44.47% with a CAGR of about 11.13. Now, because we are using leverage, we will have larger drawdowns. It's part of the system. It's how it's designed, so you have to be able to ride out those drawdowns. We had a drawdown at one point of $1,483, which if you had come in with the system and opened up your account right there at the start, that's a pretty big drawdown on a $5,000 account. But at the time, it was only about a 17% total drawdown based on the overall performance of the system up to date. Now the winning percentage, about 62, just under 62% of the trades are making money with a return to drawdown ratio of about 19.15. And here's the monthly performance you can see. And there's long periods in here where it says 0. That doesn't mean that there were not any trades. It just means you were in a trade and riding it out. For example, this $5,200 profit that we had in January of 2020, that was actually a trade that was established back in 2019, and it rode it out for several months and then closed it in 2020. So again, it's designed to get in and ride out these long-term trends, and this system really outperforms when the market is trending higher, and then typically will stay flat during bear markets and try to stay out of the crazy volatility that we get into and keep us from having big 50% drawdowns like you see many times in a bear market. If you're ready to get started, you can visit us at AlgoTradersEdge.com. You can get started today. But that's it for me, and I'll see you in the next video.